Hi everyone, and welcome to this webinar on Lease Accounting is Changing. Are you ready? I'm Isabel Shepherd, a partner in the hospitality sector at Hayesmack. And Hayesmack are a mid-tier accountancy firm serving the whole of the UK from our London office. We offer a wide range of professional services, from compliance to advisory. And two of the sectors we focus on are hospitality and property, both of which are really relevant for what we're going to talk about today. I'm joined today by Alex from Greenwoods and Lauren from Incipio Group. So Alex, if you'd like to introduce yourself.
Hi, I'm Alex Hutchings. I'm a lawyer and head of real estate at Greenwoods. We help hospitality businesses with everything property related.
Hi, I'm Lauren Courtney. I'm the Finance Director of Incipio Group. For those of you who don't know, Incipio Group is a multi-site hospitality business operating out of London. So we've got 7 sites open at the moment, and we're currently doing a big piece of work in the future Olympia development, adding 4 sites to our portfolio this year.
Okay, so today I'm going to present an overview on the up and coming changes to the way that leases are accounted for. And this will be followed by a conversation with Alex and Lauren on some common questions that finance directors and lawyers may have. This is really relevant to the hospitality and leisure sector because a large proportion of hospitality and leisure businesses lease their sites rather than owning the freehold. So what is changing and when? The way in which leases are accounted for under FRS 102 is what's changing. And FRS 102 is the accounting standard under which most UK businesses prepare their accounts each year. The change is effective for periods commencing 1st of January 2026. And for existing companies, we will start to see a really big change in the way financial statements look for the year ended 31st of December 2026 onwards. For new companies incorporated after 1st of January this year and doing a short period of accounts, the impact will be sooner. While some of this might be a little way off, being prepared is going to put businesses in the best possible position to cope with the change. The changes are mainly going to impact operators. This is because the way that operating leases from a leasee perspective are accounted for going forwards will be very different. There's actually no change to the way that operating leases from a lessor perspective, so typically a landlord, are accounted for. And therefore that landlord impact is minimised in terms of financial reporting. They obviously will see operators presenting quite different financial information though, so it is important to be aware of what's happening. Just a little bit on why this change. It's quite an interesting backstory. So the airline industry is actually generally the one blamed for all of this. The accounting standard setters were really frustrated that there was these big airline groups leasing planes and they didn't feature in their accounts. So there was no assets and there was no record of the liabilities that they'd signed up for to lease these planes. And basically, they didn't reflect the fact the airlines were locked into long-term payment arrangements. So standard setters argued that the financial statements didn't show their true financial risk. There's something that's been debated for years, and finally it is now being enacted. Airlines got all of the attention off the back of this change, but in reality, it's hospitality, leisure, and also retail and logistics companies that are probably going to feel the biggest impact here due to the way that they typically operate. So moving on, if we take a look at before and after the changes to the accounting standards, at the moment, operating leases for a typical hospitality and leisure business are held off the balance sheet. So this means that in the financial statements, they don't really feature that heavily. There's sometimes, but not always, a note that discloses the values committed to for future years, and the rent expense that they're paying sits in the profit and loss account. There's no asset and there's no liability recognised. Going forwards, however, operating leases will be brought onto the balance sheet of these companies. And for anyone familiar with IFRS accounting, which is the international accounting framework that some UK businesses do opt to follow, it will look quite similar to these businesses. This is quite a fundamental shift in what the balance sheet and profit and loss accounts of companies will look like going forward. So what does bringing leases onto the balance sheet mean? A fixed asset is recognised, which will be known as a right of use asset, and a liability is recognised for the committed lease payments. There'll no longer be a rent expense in the profit and loss account, and this is actually replaced with a charge for the depreciation of the asset and an interest charge on the lease payment. It will also mean there's typically a higher expense in the profit and loss account in the earlier years as the interest charge ends up being front loaded. Cash flow statements are also going to change, so the lease payments will be shown in the financing section of a cash flow rather than under operating activities. So moving on to calculating the impact and how operators will look to do this. I'm going to keep this quite high level and not get into anything too technical. But broadly, the date of the transition is the first day of your accounting period that's impacted. So for example, for a 31st of December 2026 year end, the first day of your accounting period is likely to be the 1st of January 2026. In the first year, the numbers will actually look a bit odd because your comparative numbers, you don't restate. So you're going to have a slight mismatch between your 2025 numbers and your 2026 numbers. And what you basically do is you take the first day of your accounting period impacted and you look at your future lease payments from this point onwards. Those payments that you are committed to pay under the terms of your lease are then used to calculate the value of the right of use asset and the value of the lease liability. Sadly, it's not as simple as just adding everything up. To calculate you have to calculate the present value of the lease payments. And to do this, you need to discount them to account for time value of money. And to do this, you have to identify a discount rate. The accounting regulators have decided to implement what they call a practical simplification here, whereby you can actually use your obtainable borrowing rate. And this is something that, the company could perhaps realistically obtain from a lender to finance a similar asset over a similar time frame. I think the thought behind this was that operators could perhaps ask their bank, although in reality these days how easy that is, I think is up for debate. There are a couple of types of leases that are exempt from this and will continue to be recognised under the old framework, and they are short-term leases and low-value assets. Low-value assets isn't actually defined, but the guidance is suggesting that things like laptops and furniture would meet the definition of low value, but cars, vans, vehicles, etc. would not. So practicalities. What do operators, those with lease agreements, need to start thinking about now? Step one is probably, ensuring you've got copies of all of your lease agreements and lease amendments on file. Might sound like a bit of an obvious one, but we do actually see, quite a few people who they never bothered to get the final signed lease agreement because they were so happy that the deal was done and it was over the line. So it might be that you need to reach out to the lawyer who helped you with the deal, or just dig out wherever that information might be saved. Step two would be to start having a think about what your obtainable borrowing rate is. If you're having conversations with your bank, then, perhaps it might be worth asking the question, see if they will give you an answer. Or it might be that you have to resort to a little bit of online research. And then step three. So no lease is typically the same. There's lots of variations, and each lease can typically have a lot of different terms that you might have to think about when you're looking to calculate what needs to be disclosed here. We've certainly seen a lot going on with regards to differing lease terms, particularly since the pandemic and the current economic climate, which naturally doesn't help. So I suspect that some operators will have a lot to think about here. Things that will impact the calculation are break clauses and lease extensions. Break clauses or extensions, basically what you need to do here is think about what you are reasonably certain you're going to do. So if you're reasonably certain you're going to exercise the break clause, you should factor that in to your lease payment calculations. If you're reasonably certain you're not going to exercise the break clause, then you should calculate the payments out to the end of the lease. And the same applies to an extension situation. It's obviously a little bit judgmental. Generally, if you don't know what you're going to do, the answer is you're probably not reasonably certain, and therefore the break clause should be ignored or the extension should be ignored. And hope isn't actually, reasonably certain there. Another interesting one that will impact calculations is turnover rent, which seems to be becoming more and more common, again, likely off the back of the pandemic. Basically, variable lease payments are treated differently to fixed term lease payments. So they're not actually recognised in the initial asset and liability calculation. They go through the profit and loss account as admin costs as and when they are incurred. So if you've got turnover rent agreements with your landlords, actually your accounts might look very different to another business or another property that you lease, whereby you've actually got fixed payments and you're recognising an asset and liability. The only time that does not apply with regards to the various lease payments is if those variable lease payments are linked to an index. For example, they're linked to CPI, and in which case it wouldn't necessarily meet the definition of variable and would be brought on to your balance sheet. And finally, we've got lease incentives. So there's lots of different ways that landlords often incentivize tenants to enter into leases. Typical situations are rent-free periods, very common in the sector, and also capital contributions to help with the fit out of the site. Both of those and any other type of incentive need to be factored into these calculations. And then finally, the other thing worth thinking about is group structures. We often in hospitality and leisure see a lot of companies within one group and some property company, otherwise known as PropCo, an operating company, otherwise known as OpCo, relationships. So it's quite common that a property company would enter into the lease agreement, but an operating company sitting elsewhere in the group would actually operate that site. And there is actually a little bit of thought that needs to be given to that situation, depending on how documented that is. I won't go into any more detail on that now, as we'll come back to it later. So if we take a look at impact on operators and following that other stakeholders, the main impact to operators is on EBITDA. So that's earnings before interest, tax, depreciation, and amortization. So there'll no longer be a rent expense sitting in a company's EBITDA, and this will be replaced with a depreciation charge and an interest charge, both of which sit outside EBITDA. So actually, in most cases, businesses' EBITDAs are going to significantly jump up off the back of this change, certainly those that have got a significant number of operating leases in place. The only thing worth mentioning there is if you've got a lot of turnover-based leases, actually you're probably not going to get that EBITDA benefit in the same way that those who had more fixed lease payments would. Net debt is going to increase quite significantly, particularly for long leases or even leases for 5 to 10 years. There's going to be a significant liability showing on the balance sheet. That will be split between current liabilities, what you're required to pay in the next 12 months, and non-current liabilities, which is everything beyond the next 12 months. But there's going to be some pretty big numbers being brought on to the balance sheet as a result of this. That's going to impact gearing, naturally, because that debt will impact all gearing ratios. Gross assets is also going to significantly increase. Not only do you bring the liability onto the balance sheet, but you also bring on that right of use asset. And that will cause quite a big jump in businesses' gross asset numbers. That actually could have an impact on company size. Gross assets is one of the factors that drives whether a company meets the definition of small, medium, or large. And ultimately that can actually drive how much disclosure is required in accounts and audit requirements. So in some cases, there could be impact there. Bank covenants is another really relevant one to operators. A lot of covenants are linked with EBITDA or are linked with the debt position. And actually, as a result of bringing these operating leases onto the balance sheet and the change in the accounting around the P&L charges, both are likely to be impacted. So the EBITDA change might actually be positive because you could get a lot more headroom, but interest cover ratios could weaken. That said, it's quite unlikely that the banks would just accept this change in reporting without perhaps relooking at the covenants or having, other expectations with what they want from you. And then if we have a look at the impact to landlords, agents, lawyers, anyone else, involved in leasing. So it's important to note, landlord cash flows and landlord accounting, actually, there's going to be very minimal change here. The operators will still be expected to pay their rent as they would under the terms of the lease, and the accounting is not going to be any different. So there will be a mismatch between the way that the landlord recognises the lease income compared to how the operator recognises the fact that they've committed to this lease. I think there's quite likely to be a change in operator behaviour here, perhaps not in the early days as people get their head around how this works, but ultimately the shorter the lease, the lower the value of the liability and the lower the value of the asset that they're going to have to bring onto their balance sheet will be. So we may see a bit of a drive towards shorter leases. Going back to my turnover rent point as well, it could be that people preference not bringing on that asset and liability and just having the P&L charge, the rent charge in their P&L as they have always done, and that would be facilitated by pure turnover-based leases. So it'd be interesting to see if we do see an uptick in operators pushing for that type of agreement. Likewise, break clauses, if there's a break clause in there, it's not a payment that you're committed to, and therefore you can exclude it from the calculation and lower the value of the asset and the liability that you are bringing on to your balance sheets. Yeah, there's very likely, I think, over a period of a couple of years, as this gets more familiar, to be a little bit of a change in terms of negotiation dynamics and what tenants are, or potential tenants are pushing landlords for. And it'll be interesting to see how that sort of flows through in due course. So, in conclusion, I guess what do operators, landlords, lawyers, agents need to start thinking about? So, operators, start modelling the impact, start thinking about whether you have all the information to hand. Obviously, I've only gone through very high level how to model that impact, but there's lots of guidance out there in terms of how that works, on a really detailed level. I'd also strongly suggest you start engaging with lenders over covenants. If you do have bank debt in place, what are the lender's expectations going to be when you are actually going to be reporting a very different EBITDA or perhaps a very different debt position? Talk to your accountant, or your auditor if you're not sure of the changes, you're sort of not sure where to start. Lots of people are now really up to speed with the impact of this and how it's going to work going forward. So it's definitely worthwhile having that conversation. And then for landlords, lawyers, agents, anyone else impacted by this, obviously the extent to which you're impacted is not going to be anywhere near as much as the operators, but I think it's still quite important to be aware of the changes, because actually a lot of the financial information that you may see from a potential lessee/operator, it could look very different. And also there could be a shift in the negotiation focus from operators when they're looking to enter new leases. So that summarises, everything that I was going to cover with regards to changes to lease accounting. And if we now move on to a bit of a conversation with Alex and Lauren, I know they've got some questions. We will go from there.
So, well, thank you for that, Isabel. That was really, really helpful. I guess just touching on one of your points that you mentioned a bit earlier around group structure. At Incipio, we don't always have the property lease in the same company as our operations. So that kind of propco, opco setup that you mentioned. So what does that kind of mean for us, and how do you think we will deal with this?
Yeah, I mean, as I said earlier, that's really common, and we actually do see a lot of structures set up like that. I understand it's because sometimes I think the landlords sometimes push for this, but sometimes the operator just has a preference to hold the lease in a separate company from the operating lease, and particularly where the company might run more than one site. What we normally see actually is more of an informal sublet. So there's no formal documentation between the operating company and the property company. So there's nothing strictly legally documented. What it comes down to is effectively the legal situation. So if the propco signed the lease with the landlord, legally they're the ones committed to making the lease payments, and they're the ones that would need to bring that asset and liability onto their balance sheet. This is actually going to make the accounts for those like what are normally quite basic propco companies quite a bit more complicated, and it's going to be quite a bit more involved preparing those accounts and also getting through an audit if the company does require an audit. From an opco perspective, you basically need to consider, is there a legal obligation in place here? There isn't any guidance here from an accounting perspective. I know that one view is like a lease is typically a sort of signed, documented, signed on the dotted line agreement. And therefore, perhaps if there's no formal relationship between the propco and the opco, there's no lease, and therefore there's nothing to account for in your operating company with regards to an asset and liability. Yeah, hopefully some guidance will come out. It's not possible to tell at the moment. I mean, Alex, I'm not sure if you do have a view on that from a legal perspective.
Say the word lease and my ears prick up. I suppose the thing for me, so the opco propco structure, sometimes you get away with group sharing. So most leases will say, group companies in the same group. So if you're, common shareholders or one of you owns a certain percentage, can't remember it off the top of my head, 75%, I think, of the other, you can share without any form of documentation in place. So there is that. Some people go as far as Propco takes a lease and then they put a formal document in place. Even without a document, you can argue you've got a lease. But I think, for the purposes of stamp duty, normally you would look at an actual written document. So I think for most OpCo propcos, it would be you rely on the group sharing kind of argument, provided that's allowed under your lease. And then you wouldn't put it on the OpCo balance sheet by the sound of it. The one I wanted to ask about, Isabel, on that though is so a lot of the advice I give clients is compartmentalizing sites. So having SPVs for each site as opposed to OpCo propco.
Yeah.
And how that's going to work. I mean, some of them do it for business rates and small business rate relief. Some of them do it for compartmentalizing those sites, so they've got options with what they do if a site works out or doesn't work out. Are they going to have to put each of those leases onto the balance sheets of each of those companies?
Yeah, they are. And I think this is where there'll be a real time and cost aspect to this, because those propco companies, let's call them, that, if you've got 10 property companies that have each signed an individual lease, in the past, you've always had to prepare accounts for those entities. You've always had to file accounts. You've perhaps always had to have them audited if the group is big enough. Actually, those accounts are just about to become an awful lot more complex, because if that company signed a lease, you are going to have to go away and do a calculation to work out what your right of use asset is. and what your lease liability is. So those accounts are really going to ramp up in terms of complexity, and that complexity then flows at the group when you're preparing your group accounts and your consolidated accounts. So yeah, there's a real time and cost position, both from the finance team and both from looking at things from a compliance perspective there. So I do wonder if we'll see a little bit of a shift. I can't imagine that, people would probably err on the side of the what's the best legal position, perhaps rather than, how much work the finance team are going to have to do. But it will be interesting to see, and I think it will be a bit of a shock for some of those companies that do have that structure. I know that the key driver for when people tend to bring everything under one entity or perhaps one operating company and one property company is when it just becomes too much. You've got too many sites, far too many companies, the admin that comes alongside that just becomes sort of insurmountable.
It does feel like something though that in that sort of first year of adjustment, there will be, some real time and effort that goes into it, particularly. But once you've sort of got that structure set up, you'd like to think that actually rolling that forward each year probably isn't going to be as time intensive as maybe it is in that transition year. Is kind of what I would think. But yeah, it's definitely going to have some additional complexities to what is like generally quite a straightforward audit.
Yeah, no, 100%, you're right. The first year, like time investment and work that will need to be done to do these calculations far outweighs that roll forward position, particularly if your leases aren't changing.
Yeah.
Yeah, you do that calculation on day one. Once you've got your head around how that calculation works, you can set it up and you just roll it forward to the end of the lease. But I guess that is one reason why I think about this sooner rather than later. Because if you leave
Not
it
on
too
the
late,
29th
then
of
you're
December 2026.
100%.
Yeah.
On the calculation, sorry,
No, go ahead.
yeah, really, yeah. On the calculation point, so if I'm drafting something and like landlord side, we want to reserve everything as rent. So you've kind of got like a main rent, so X pounds per annum, and then there's service charge, and service charge is a massive issue for landlords at the minute. 'Cause it's creeping up and up and up. But that's reserved as rent legally for kind of enforcement issues. And then you've got insurance rent, and then you've got utilities, and then you've got rates. Does that all come into this right of use cost, or is it just pure annual rent?
Oh, interesting. I think it will come down to what you are sort of legally committed to.
Yeah.
I mean, the whole background to all of this is an operating lease is effectively a financing transaction. So you are paying over a period of time to obtain the right to use an asset right now. Um, so I guess if the lease is worded so that those non-rent costs that are perhaps grouped in with rent are, what fixed and what you are required to pay over the term of the lease, I think they probably would fall within that calculation. It's probably going to come down to specifics on the wording though.
I mean, that's massive. Like sometimes service charges as much as the rent.
Yes, I have heard that things are
Yeah.
heading that way, which
And VAT, if a landlord charges VAT on the rent, I assume you discount that. Or
yes, that position won't actually change. So the VAT is when you pay your calculation would be net of VAT. And then from a VAT position from a company perspective, that's driven from what's known as the tax point. And the tax point is basically when the cash leaves the bank or when the invoice is received. So that should still, run as normal. If in a quarter you make the payment or you get the invoice, it flows into that next quarter's VAT return, and the payment is made over at that point.
the calculation element, if it was going, because for stamp duty, you pay stamp duty on the VAT inclusive figure. So it was trying to work out,
Yeah.
are they also going to include the VAT on the committed costs?
Yeah.
All
Yeah,
right.
no, interesting question. Um, yeah, lots to think about, that's for sure.
Definitely.
Um,
I guess sort of moving on to another point that you touched on before was about covenants. And I think that's going to be, yeah, definitely an issue that's going to impact a lot of people in the hospitality industry. So I guess if companies have covenants that are linked to EBITDA, what would your advice be? What should they do? Do they need to go to the bank and renegotiate, or should they try and keep it on sort of like a UK gap pre-lease adjustment basis? What would kind of your advice be?
It's hard to know which way the banks are going to go with this, to be honest. I haven't actually spoke to anyone who works on the bank side. Probably would be sensible to do so. So, I mean, my recommendation would be just speak to your relationship manager there. Are they even on top of these changes yet? I'm not sure. Um, I think staying silent is probably the worst thing that you can do. I mean, in some instances, the boost in EBITDA that businesses are going to get actually just could give them so much headroom on the covenants that there is perhaps an incentive to not shout about that too much. But you never really know what the banks are thinking. You know, are they going to look to renegotiate those covenants and force through a change off the back of this? Or, as you say, are they going to request that you report to them kind of pre the change in lease accounting? In which case you're perhaps going to be having to run two sets of numbers or run a set of numbers under FRS 102 as it will stand, and then do that separate calculation, reversing that out to present to your bank in whatever numbers you're sending to your bank each month or each quarter, however often you're reporting to them. So yeah, I'm certainly very interested to see how all of that plays out. I don't know if they've your banks at Incipio have flagged anything and you've started that conversation yet.
Well, yeah, out of interest, I guess we did a bit of a refinance last year, and as part of that, so even as early as last year, they were very on it with the changes that were going to be
Okay.
happening with lease accounting, and stipulated kind of in our financing agreement that EBITDA would not take into account the kind of lease accounting changes. So
Yeah.
um, I think they will probably be quite hot on it.
Yeah.
And I would be surprised if they just let it lie because, like you say, EBITDA is going to go through the roof for some people.
Yeah.
And, I think ultimately the covenants, I don't want to talk like a bank, but the covenants are there as a measure of performance. So if they're not accurately measuring kind of actually how the business is performing, but their EBITDA is just higher because of an accounting adjustment, then I think they will be looking to amend or renegotiate or have a side letter that says that you have to kind of have these amended in line with lease accounting.
Yeah. 100%. Because there'll be lots of loan agreements out there in place that, the banks won't have been able to preempt this change, for 5-year loans that are, perhaps 3 years in. I suspect the accounting changes won't have been on the radar then, and there won't have been the opportunity to put in any clauses just to define what would have happened.
Yeah.
Yeah, and this the other thing to think about there is actually if you are a business that gets audited, which if you're not a small group, you will be in that position. You'll probably be looking now to, if you're December year end or you mid audit, are you going to be signing your accounts off soon? You are required, the directors are required when signing off those accounts to think at least 12 months ahead from a going concern perspective. And that's going to fall into 2027, which will be in the period when you're doing this reporting under the new methodology. So again, is that something that you need to be thinking about to get comfortable that the business is a going concern and that the statements you are making in the accounts, are valid and you have considered everything there.
Yeah, definitely. I think also from a reporting perspective, I guess when you say, if you were doing it on a sort of UK gap, excluding lease accounting for the bank, would your sort of recommendation be to, I guess, do the lease accounting adjustment at the year end point, and then actually your kind of mid-year, management accounts, things like that could actually represent just your kind of normal what we do now, and then you do your year end adjustment, and then that obviously makes it audit compliant, but also keeps the banks happy, I guess.
Yeah, it's a good question. And actually, it is something that we got a little bit of oversight, I guess, of when businesses that report under the international standards had to make this change. So I mentioned earlier that I think it was about 5 years ago now, this change came in for international reporting standards, and it was a really big shift that people with lots of leases kind of struggled to cope with. And actually, the approach that a lot of them took, that a lot of those businesses took, was carry on as normal with regards to their accounting system and their internal management reporting and post a year-end adjustment just
Yeah.
to get their statutory accounts in line. I would say that can get a bit messy. Some of the size of some of the journals that were having to be posted were pretty large. And naturally, when you get that rolling forward year on year, you end up with quite big differences between reserves balances. So if that's the route that people choose to take, it's just worth being mindful that you've got to have a really good track kind of outside of your accounting system and
Yeah.
internal reporting as to what's going on there. Yeah, it'd be interesting to see, as people get more used to this, actually, does it just make sense to have your statutory numbers in your accounting system? And then when you're having to pull off stuff to report to the bank internally, having a way that you get that out of the system and you post some probably fairly straightforward adjustments each quarter if you're needing to do it each quarter, just to reverse that out. To an extent, it's probably going to come down to personal preference and how well set up you are with accounting system, management reporting, how well connected all of that is.
Yeah.
Um,
And I guess
yeah.
in terms of just reporting generally, I guess that EBITDA is, as we said, going to increase for a number of businesses, particularly obviously for 2026 versus 2025. So how do you think that businesses will report their figures for those years? Do you think that they will say, EBITDA for this year was this, and then my EBITDA for this year was this, but lease adjusted EBITDA is X to make them comparative? Because, like you said, you don't have to do a restatement of the prior year figures. So there's going to be a mismatch for those kind of 2025, 26 years.
Yeah, again, we can take a little bit from what happened when those international standard adopting companies went through this. A lot of their preference at the time was to disclose sort of the old version alongside and have their strategic report and the front end of their accounts kind of reversing out the change and explaining what it would look like without the lease accounting in there. Um, there's no requirement to specifically state the numbers under the old accounting framework, let's call it. But there is a requirement to make sure that any strategic report or any kind of front end reporting in the accounts gives a true and fair view. And I think I sit on the side of the fence where how can it give a true and fair view if you haven't acknowledged the change and you haven't acknowledged the reason that you've got a massive increase in your EBITDA or massive change in any of your numbers as a result of this. So I think definitely, in businesses where I'm signing off the audit report, I think I would be looking for at least some explanation. But yeah, as I say, there's no actual requirement to go, well, this is what it looks like under the new model, and this is what it looks like under the old model.
Yeah, because what I sort of foresee happening is, like you say, I think people's accounts will kind of reflect that and say, yes, this is the kind of the change. I just wonder, when that people do report their results to publications and hospitality press, and whether those figures, I guess, will be disclosing of that matter as well. I just think will be interesting to
Yeah.
see.
Yeah, I completely agree. I think everything will have to be perhaps taken with a pinch of salt if we're seeing some particularly large
Yeah,
jumps.
exactly.
It would certainly lead me to question, oh, hang on a minute, why is that really on a like for like basis? I guess that could actually, for those who just have no idea that this is going on and are just reading, hospitality press, it could be quite misleading.
Yeah,
Um,
completely.
it'll be interesting to see how businesses approach it. Also, those businesses that aren't big enough to be audited, there's not going to be perhaps anyone pushing them to be like, hang on a minute, let's just make sure this gives a reasonable position that explains what's gone on here.
I know you said landlords, obviously it's not really going to impact them in terms of accounting, but obviously they always ask for accounts from prospective tenants. So, and then they use that to work out how much capex we want to offer them, how much rent free do we want to get, where do we go. So for landlords, they really do need to understand that they're going to get these figures. Originally, when I knew we were doing the seminar, I thought, oh, the account's going to look worse. But if they're going to look better, like landlords are really going to have to spend time examining those things and not just thinking, do I like this concept? Yeah.
Yeah, no, you're right. I think it's hard to define whether they're going to look worse or better. Like EBITDA is definitely going to look better, but actually, a lot of businesses don't necessarily state that in their accounts. They might put it in the front end, in the explanatory sections of the strategic report, or some might optionally pull it out of their profit and loss account. But actually, EBITDA is a non-statutory measure to start with. So yeah, it's interesting, what is worse? Gross assets are going to go up quite a lot. Some might see that as positive. Liabilities are certainly going to significantly increase, and I struggle to see how anyone can see that see that as a positive change, to be honest. Particularly, non-current liabilities. If you're looking at what is a business going to have to pay out in the next 12 months, that number is going to jump up if you've got a lot of operating leases. In terms of cash flows out, nothing's changing, but actually what they're reporting on really is. Then you've got your kind of statutory format P&L, which will show a higher operating profit because you haven't got any rent in there. And instead, you've got that replaced partially with depreciation and partially with interest. And that interest will sit below operating profit. The overall charge actually over the term of the lease doesn't necessarily change. It's just kind of the way it's reflected in the accounts in nature and over the period of time that will change.
So why do you charge interest? Because obviously annual rent is until you get to a review point, it's a year five, it's a fixed figure. So why are we saying, oh, I've got to pay 250 grand a year for 5 years and then X amount of interest on that?
Yeah, it's a really good question, to be honest. It comes back to that point I made before on the kind of core concept around what is an operating lease. And it's that right to use the asset today, if I sign a lease today, but pay for that over a period of time. So it's basically considered to be like a financing transaction. And if you were financing something, you would naturally be paying interest on it. So yeah, you're basically the liability that you are recognizing is effectively today's value of said financing. And then every year your liability decreases when you make your rent payments. So you pay your quarterly rent, say, and that liability comes down. But actually you charge interest on that liability that sits in your profit and loss account, and that builds that back up slightly. So you've got kind of two moving parts to your liability on your balance sheet. It's worth noting the liability, the interest is charged on the liability. Therefore, at the very start of the lease, when you've got a very high liability, because you might have 10 years of payments that you're committed to, naturally, if your interest rate that you're using is 8%, it's going to be quite high. Actually, as that lease progresses and kind of you work through that lease, your committed liabilities will decrease as you make your payments, and then that interest charge gets a lot lower towards the back end of the lease. So yeah, it's a little bit of an odd one. It's quite a kind of accounting concept in terms of the way this time value of money is reflected and bringing the lease onto the balance sheet that I do appreciate will seem odd to many. But yeah, that's the general gist of why the interest is shown as it is.
I guess going from liability to assets now. So we've got these right of use assets on the balance sheet. When we get to year end and we're looking at our impairment review of assets, whilst we're prepping kind of our year end figures, do we have to then also consider these right of use assets for impairment as well?
Sadly, yes. So yeah, that higher level of gross assets that will sit on your balance sheet, gross assets being everything, but specifically fixed assets. Yeah, when you are preparing, year-end numbers and and as you're required to do, thinking, are there any indicators of impairment? You should be factoring in all of your fixed assets. So that's your right of use asset as a result of the lease liabilities, and then also your, let's say, more traditional fixed assets that we're all used to, such as leasehold improvement, fixtures and fittings, etc. And that was something actually that was quite commonly missed with that international accounting standard change. I think a lot of people thought they could just ignore the lease liability and just look at everything else. But unfortunately not. You do have to think about everything. And it does mean actually that you can end up in a situation whereby you've perhaps got an underperforming site and you've had to impair down the fixed assets to what is deemed a recoverable level. You're still showing that full liability on your balance sheet, and that's perhaps not going to be a pretty picture in some circumstances. Just because you've impaired the asset, sadly the liability is treated, completely separately. And you obviously don't get out of the legally contracted position just because your asset's underperforming and isn't where you would want it to be. So yeah, that's definitely one for operators to consider. More of a year-end point than an ongoing point.
Yeah, absolutely. And sort of what would your indicators for impairment that you would be like expecting people, operators to look for on their right of use assets?
So big changes in the market. In terms of I think the standard states things like technological, wider economic environment, etc. At the moment it's pretty tough out there for hospitality and leisure businesses. I wouldn't say that, you'd then just go broad brush, well, it's a tough environment. Everything has got an indicator of impairment. I think, being practical, it comes down to how is that site performing? What are those numbers look like? Is it breaking even, or, is it generating a positive EBITDA? Also how long's left on the lease is quite a big factor. If you've not got that long left on the lease, sites making a sort of moderate EBITDA, that's probably not an indicator of impairment. If you've got a 20-year lease and you're barely breaking even, you're probably in there's an indicator of impairment camp, and probably need to be doing a more formal calculation there.
Great.
It's a bit of a judgmental one.
Yeah.
Short-term leases, I mean, what have we got any kind of guidance on what they are? For a while, leases were getting shorter from kind of 15 years down to about 7. I seem to see people getting a bit longer now as they're trying to think, we want long enough to build up a business and then exit. But have we got a sense on what short-term lease might be?
We do. So that is actually defined,
Okay.
and it's defined as 12 months. So I think being realistic for any kind of landlord operator relationship, it's quite unlikely that anything's going to fall in scope here. Um, you know, very few leases certainly from a property perspective are less than 12 months, aren't they? And I mean, even from another asset perspective, if anyone's leasing a vehicle or a car or anything. So yeah, I think there's going to be very few leases that fall into that less than 12 months short-term bracket.
I mean, even if people put in a break, the problem with breaks is the more breaks you have, the higher the landlord wants the rent because there's less certainty of income. So, if you suddenly start putting in 3 and 5 year breaks, you end up paying more anyway.
Yeah, it's going to be a bit of a trade-off there, I think. What's the operator preference? Yeah, you get the break in 3 years, then actually, and you're not reasonably certain that you're going to extend beyond the break, which you're probably not when you first enter the lease. You're only recognizing effectively the present value of 3 years worth of lease payments in your accounts, which is perhaps great. Lower liabilities are showing on your balance sheet. But yeah, the flip side is the landlord's probably going to charge you more there. So
That's contrary to stamp duty again. Stamp, if it's a 10-year lease with a 5-year break, you calculate the MPV based on 10. So
yeah.
it's a lot
Yes.
for people to remember.
Yeah, 100%.
Yeah.
Yeah, this reasonably certain piece is an interesting one, and it is really judgmental. And actually, for anyone doing an order or signing an order report, how do you prove that? It's really hard for, what sort of questions do we ask to land one way or the other? Yeah, just I think that point on, if as an operator you're not sure, you're not reasonably certain, are you? But if you've perhaps got more viable plans and you've thought about it and actually it's beneficial for you to not take that break or to take an extension, then maybe you are going to lean more towards that reasonably certain position. You've then got layered on top of that, I guess, where do you want to land in terms of where do you want the numbers to look like in your accounts? I think typically the view will be the shorter the lease, the better. But
You talked about uncertainties in terms of turnover rents or maybe options for leases. A lot of outside of London sites may still have rights of renewal under the 54 Act, which is obviously a statutory right for them to stay in. And if you do nothing, landlord does nothing, tenant does nothing, you just continue your occupation kind of until someone serves a notice. So you're almost, if you've got a 54 Act lease, the suggestion is it will continue unless you do something. How do you think that's going to play out? It's less of an issue and they're consulting on whether they change it or not. But what are your thoughts on that?
yeah, it's not something I thought about before, actually. Really good point. I guess you're in a very good position if your formal lease has come to an end, but you can stay as a result of that act.
Yeah.
I can't see that you'd have any asset or liability to be recognizing in that situation. And off the top of my head, I think you'd be reverting to a position where you recognize your rent as and when, the period that it relates to, as people do now. So there is perhaps a positive impact to think about there certainly from a financial reporting perspective. I guess you've got less certainty from a legal perspective.
I mean, in theory, for a tenant, if you're a tenant holding over, you can terminate that on 3 months' notice under certain
Mm.
circumstances. So then it does fall within the short-term arrangement because you say, well,
Yeah.
actually, I might only be here 3 months, so there's no point in recognizing that liability.
Yeah. I don't think there'd be a liability to recognise because
Yeah.
technically you wouldn't legally be committed to paying that rent for, as you say, any period beyond 3 months.
Yeah.
Um, so yeah, the whole kind of bringing the asset and the liability onto the balance sheet, assuming you were in a lease originally, you
Mhm.
would do that on day one of transition, that would all unwind out. And then you'd come to the end of the lease and you'd stay there, and then you're in the well, I'm only committed to 3 months
Mhm.
position. So there would be, there'd be nothing to show there.
Just rent deposits was another thing I was thinking about in terms of for tenants, they want to get the rent deposit back as soon as they can. So you tend to find early release mechanisms, which are either profits tests, so net profits are 3 times the rent for 3 years, net asset tests, so net assets are 5 times rent for 3 years. Is it going to be easier to secure a release on these accounting standards? And again, the landlord's going to have to factor that in.
Yeah, I think it might be harder, certainly in the early days. I mean, it depends how net profit is defined, but assuming it includes depreciation and interest, your total depreciation and interest recognized in net profit at the start of a lease is going to be a lot higher than at the end of the lease, and also that you would have been recognizing under the old lease accounting. So to me, that says, well, okay, well, you're going to have a lower net profit, therefore you're going to struggle to get to the point where net profits exceed that 3 times
Mhm.
calculation. So yeah, so for me, it seems like it would be harder. I don't know whether net profit is typically defined
We leave
in
that to
leases.
accountants.
Yeah.
So yeah, yeah, which is it's
I
just
would go straight to the lease agreement and be like,
it's
is it defined anywhere or is it the
no, it's all
statutory
lowercase.
definition?
It's all lowercase, not defined. Yeah.
Um, yeah, I suspect it does include those numbers. So I think that it will be harder, certainly in the early days of the lease.
Mhm.
It's always going to be harder in the early days of the lease anyway, while the site matures, isn't it?
Yeah.
Um, Yeah.
I guess something that when we're looking at leases for new sites, and something that we obviously push for a lot of the time is rent-free periods or landlord contributions or fit out incentives, all of those kind of things. So how do you treat those, I guess, on transition and then rolling forward for any new sites that we take on?
Yeah, these are definitely becoming more and more common. Certainly the capital contributions. I feel like a lot of the leases we see when we're going through audits or preparing accounts for clients, there's a lot more that landlords are paying out to help support the tenant in those early days. So the rent-free period is actually quite a simple one. So if you were taking out a lease today, let's say, um, there's nothing, your rent-free period, there's no cash to pay, and therefore when you're working out your future committed lease liabilities, there's nothing to factor into that calculation. You just look at what rent are you committed to pay and when, and discount that back to today's value. So that piece is relatively simple. If you've had a rent-free period and it was kind of pre-transition, again, it's just ignored. On that day of transition, you're looking at what do I owe in cash from this day onwards.
Yep.
So rent-free periods, I think, should be sort of fairly easy to manage. Capital contributions, basically this amount is actually deducted from the asset value on day one, let's call it. So day one being transition or day one being inception of the lease. So if the landlord's funded, let's say 500,000 in terms of supporting on fit out, that's going to come off the right of use asset addition that you would recognise when you signed up to that lease.
Okay. That's an interesting one because that's not how that. Well, I guess they can be treated in different ways at the moment, but that's quite a change, I
It
guess.
is quite, yeah, it is
Yeah,
quite a change, yeah. Particularly when some of the numbers, that the landlords are really willing to commit a lot these days to get tenants into certain sites. You
yeah.
could, if they've given you a lot to help with the fit out, you can end up with quite a mismatch on day one between your
Which is
asset and
to say, this
liability.
could be, yeah, massive mismatch.
Yeah.
Okay, that's interesting. I guess looking forward in the future, if we were sort of in a position to pay out dividends to our shareholders, how would the changes to lease accounting kind of impact the amount of distributable reserves that we have to pay?
So it actually comes back to that point I made earlier about the sort of total of the depreciation and the interest that replaces the rent expense being higher at the start of the lease and being lower at the end of the lease. Net position of the whole lease, exactly the same. Um, but for those companies that are in dividend paying positions, they are going to have lower distributable reserves from the start, because the depreciation and the interest are factors that you would, they are costs that you would consider when thinking about, how much reserves a business has to distribute. So yeah, in those early days, the P&L charge is going to be higher, which will reduce those reserves.
The short-term impact is worse, effectively,
Yes,
and that
yeah,
improves over time.
exactly that.
Interesting. And I guess, and when we're talking about tax, and like distributable reserves, do we have any kind of VAT or corporation tax implications as a result of these changes?
Yeah, so that it's purely that tax point that I mentioned previously, no actual real impact there other than I guess a bit more of a mismatch between what your accounts are showing and what's going through your VAT return. Corporation tax is an interesting one. So the tax will actually follow the accounting treatment.
Yeah.
So you get a deduction for your rent at the moment. From a corporation tax perspective, you will get a deduction for depreciation and for interest going forwards. Again, back to this point of if you've got higher P&L charges at the start of a lease, you're going to get a tax deduction, which there's a real benefit to if you are tax paying in the early days, but that will unwind and flip the other way towards the end of the lease. So again, that whole over the term of the lease, no impact. Early days, there's perhaps a small tax saving to be had there, because it does just follow the accounting treatment. The other kind of common question in that area is for businesses that get caught by corporate interest restriction. It's basically a cap on how much interest you can deduct when putting together your tax computations. There's a very high level overview of it anyway. Your interest charges are naturally going to go up as a result of this change, but thankfully that interest charge won't be a factor for businesses that do have to think about corporate interest restriction. It's excluded on the basis that it is an operating lease. Even though that lease definition is kind of going away from an accounting perspective, but yeah, tax perspective, they'll exclude that interest charge, which is actually really positive because a lot of businesses do have to think about that restriction over interest deductibility. And if it was included, there would be possibly some big jumps in tax that people were required to pay.
Last one for me, I guess, is on rent reviews. So you touched a little bit on RPI and CPI reviews kind of there, but most rent reviews be open market or, percentage of turnover rent paid, or, I mean, government might even ban upwards only rent reviews, so they become upwards, downwards. How's that going to play in?
Yeah, it typically is dealt with through basically what's known as a lease modification. And in most circumstances with a lease modification, you basically recalculate the asset and the liability on the date of that modification and recognise what is owed, whether that be upwards or downwards. If we do start to see downwards rent reviews, it might reduce the asset and liability that you're carrying. So yeah, basically the day that that's all kind of legally agreed, you take a look at that, do a recalculation and adjust your carrying values going forwards.
So you might do 10 years at 500,000 with interest, and then if it goes up in year 5 to 600, you do an
Yeah.
adjustment at that point.
Yeah, you'd be doing sort of right. What am I looking at for the next 5 years? Higher total, and you get a jump up a bit up in your asset and liability accordingly. Be interesting to see if the ban on upwards only rent reviews actually does lead to too many downwards rent reviews. We will see.
Yeah, I think it'll lead to landlords just doing fixed rent increases, structuring it that way.
Well, it's interesting you say that because actually, if it's fixed increases that are defined in the lease agreement, they will be included in these businesses' future lease commitments and therefore flow into the carrying value of their asset and liability. So there may be operator leasing pushback there to try and avoid that where possible. So yeah, slightly, I guess, conflicting things at play from a landlord and operator perspective.
Yeah, I mean, we can't work out if landlords are going to go for shorter leases and then renegotiate every 5 years. And then again, from a tenant perspective, I mean, certainly, Lauren, probably you don't want to be signing up to many 5-year leases and paying the amount you pay for your fit outs.
No, exactly.
Yeah.
No, we've effectively, most of our leases are pretty long, to be honest.
Yeah.
And so yeah, looking at this, I'm thinking, gosh, there's going to be quite a significant impact.
Yeah. So if landlords start saying we're just going to renegotiate every 5 years, so we can pick a new rent, it's not great for tenants and kind of a return on investment perspective. But then landlords aren't going to want to risk having downwards rent reviews on their stuff.
Yeah. Perfect. Well, I don't know if either of you have got any more questions, or any kind of
No, I
points,
think
things
that was
worth
everything. That was
discussing.
really helpful to kind of talk through. So thank you.
Yeah, thanks, Isabel.
Excellent. Well, thank you everyone for listening. Hopefully you've taken away some useful knowledge. There's definitely lots to think about. And I'm sure, to be honest, it's prompted more questions from many who have been listening. So we will leave it there. Just before we close, worth flagging, we've got a number of exciting events coming up at the Leisure Property Forum, the LPF. We've got our annual dinner on the 18th of March at the Hilton London Bankside. And then we've got a seminar on occupation and operation costs, innovative strategies for 2026. So that's going to touch on things we've alluded to actually in our discussion here, the rapid increase in service charge that tenants are paying, and just the general rise in operating costs as a hospitality and leisure operator. So that's in the diary for the 29th of April 2026. So yeah, do check out our website and sign up and come along if you are free.